Hi, my name is Michael, and I am wanting to talk to you about several things, including many people. I'm wanting to discuss in this video about the indicators of a bear market coming in the coming months. And so many people believe that the U.S. economy is strong because the market's at an all-time high and unemployment looks low right now. And when you look at um, beneath the surface, you start to see debt, liquidity, global capital flows, and other things starting to crack. And it paints a very different picture than what we're currently seeing. So in this video, I'm going to walk you through like several indicators that suggest a bear market is coming, and it's increasing in the coming months. None of these indicators are guaranteed of a market crash, just to be evident. So I just want to add that as a caveat. And so let's. I have several things to talk about. So let's get into it. So currently we have $138 trillion in debt, according to the debt clock, and that can be seen here. Um, and So we have about 15 years ago, our debt to GDP ratio was at around 60%, and so that was around 2008. And so currently, we're looking at GDP ratios at 128% and 3.6 of the gross national product. And you may think, well, that's no big deal. Well, it is a big deal because we have two things that has happened within the last year and within the last month. And so one of those is the petrodollar. So the petrodollar was started by Richard Nixon, and so we're our money used to be backed by gold and is no longer backed by gold. And so they came up in 1971 with the petrodollar. The petrodollar was an agreement with OPEC countries, including Saudi Arabia, to actually buy U.S. oil. Well, not U.S. oil, but it was oil in U.S. dollars and then convert it into their currency. So that kept the debt relatively cheap. So during the about around 2024, the Saudis and other countries such as China, some other countries in South America, including India, did not want to convert oil into U.S. dollars. They didn't want to buy U.S. dollars because we had so much debt. So instead of buying oil into U.S. dollars and trading it into their own currency, they just skipped going from U.S. dollars into their own currency. And so that basically killed the petrodollar. So the petrodollar is now dead, and we now owe more interest on our debt than we've ever had before. So, and then of course, the other thing that happened in the last month, Japan has been a recent ally of ours for at least 40 years. And so within the last 20 years, they've been buying our national debt. So currently it stands at $1 trillion. So after 20 years, they refused to buy the U.S. Treasury bonds, according to Morningstar, in order to raise the Japanese yen, because Japan's economy has been terrible. It's been in shambles. It's been in shambles for years. So in order to boost the Japanese yen and head off inflation, they must sell the U.S. Treasury bonds, and they've been doing that and investing in gold. So you're saying, okay, how does that affect the U.S.? It does affect the U.S. It affects the U.S. markets here. And then, of course, we have unemployment. And so before I get to unemployment, I just want to briefly show you how much that our GDP ratio from back around 2008 was hovering around 60%, so now it's hovering at 130%. Not good, not good at all. So let's move to unemployment. So the unemployment rate, according to Ludwig Institute, has been calculated at 25.2%. And so 20 years ago, the way the U.S. Calculated unemployment was looking at people who had been unemployed and had only been working part-time. And it also included those who had been unemployed and had been discouraged and no longer looking for work, compared to the 4.4% by the U.S. Bureau of Labor Statistics. So, now we don't include those two factors at all, and so it paints a different picture than what's being portrayed now. So the other thing I want to talk about is the Federal Reserve, and this is this is a big topic to cover, and this within this video, but we're going to talk about quantitative, shrinking or tightening versus quantitative easing. So I want to cover about the inflation first. Inflation started off at 9% around 2001, and we've been dealing with inflation since that time. So we've been dealing with inflation by the Federal Reserve printing money and increasing liquidity, and therefore we've seen prices go through the roof. We've seen it in grocery stores. We've seen it, the price of goods that people have been selling. And so, anyway, the things that I want to talk about there is that the reason that that inflation occurred was because two things. Number one, the Federal Reserve kept interest rates they kept them low for so long, and then not only that, but they started printing money into the marketplace, and therefore we had inflation. So let's talk about quantitative easing. So the quantitative easing is that the Federal Reserve prints money, adds money into the marketplace. It increases liquidity. And then, of course, you have financial conditions loosen and asset price often rises. So the CPI is currently at 2.71%, and interest rates are sitting at 6% according to Freddie Mae. So let's talk about, before I get into anything else, let's talk about the Fed has proposed and has instituted the Fed Now. So the Fed Now has improved cash flow for businesses and households by providing just instant access to your funds. And so about 4 years ago, they proposed the CDBC, the digital banking currency, so they wanted the Federal Reserve banks to participate in the CDBC. So any cryptocurrency has both a general ledger and a transaction part of things, and so the transaction part of things is what they can track of what you purchase. And so Nancy Pelosi says never let a crisis go to waste. And so I believe, this is just my opinion, that they're waiting for something to happen, that they're going to use a crisis in order to enact the CDBC. So right now, the Federal Reserve does not have and it's fed now the CDBC, but it can and will in the future, could possibly go to that. And so the next thing I want to talk about is, why is gold prices and silver prices rising at an exponential rate? Well, very easily, I'm going to tell you four things that is going to, the reason why gold prices are rising. China is buying up gold at an exponential rate since their economy has been struggling. They've been doing this over several years, and since the tariff has been, since we put tariffs on them, they've been they've been investing in gold now. So since Japan is no longer buying, our treasury bonds or treasury bills anymore, they're trying to raise the Japanese yen, so they're selling the government, our government bonds, and buying gold. And then, of course, on March the 20th, 2025, Trump signed an executive order, immediate measure to increase mineral production, to activate the Defense Production Act, to fast track domestic mining and dismantle government red tape. So, that's the reason why we're seeing gold prices and silver prices rising. And then, of course, you have the central banks are buying gold to hedge against inflation. So I'm going to show you in this next picture that how gold prices have been rising over the last year. And this is from FinFiz. They report future prices for gold and silver. And at any rate, these are the reason why gold prices are rising. So at this next slide I'm going to show you is the indicator over the past, at least 60 years of gold versus silver prices. And so you have silver prices being reflected in blue, gold prices is reflected in the yellow. And so therefore you're seeing that gold and silver prices have risen exponentially before a crash of 1981. And then you also see here where it had risen greatly during the 2008 market crash, the financial market crash. So there again, we see cracks that can indicate a bear market. So the other thing that I want to draw your attention to is, in my personal opinion, of where to direct your money. So you should be investing at least 40 to 50% in stocks. Don't, where you diversify, not putting your money into just one stock. And the other thing is at least 20 to 30% in real estate. And we've seen over just the course of the last 5 years of inflation how home prices have been driven up exponentially as well. So home prices have been going up, and so it's not a bad idea to invest in real estate because it actually holds, the value. So the third thing I would say is invest 10% in gold and silver. So you can see just from 2008 to now, gold prices was at $1,300. Now it's at $5,000, $5,500 just to be exact. So, and then of course I would say at least maybe 5% in cryptocurrency. And then after cryptocurrency would just be have a Roth IRA that you could direct money into. And that, of course, you'd be paying tax on it as you're putting it in there. So, these are all the things that we see coming. And then going back, I want to just for instance, with the CDBC, they did propose HR 1919 on the CDB Surveillance Act, sponsored in March of 2025. It was proposed in the House and the Senate. It got passed in the House, but didn't get passed in the Senate, so it didn't become law. No surprises there, but so together, rising debt, weakening treasury demands, labor stress, tightening financial condition, and then of course the central bank behaviors all suggest risk that's building up beneath the surface to indicate a bear market is coming, or and so along with that, I'm going to say that Jerome Powell is caught in a rock and a hard place. He has cut interest rates of 75 basis points, which is not a whole lot. Right now, he has decided not to do anything at all, but I think he probably should lower interest rates a bit more, to spark on to make the economy go even better. But the Federal Reserve is really in a tight situation right now, and they're not really sure what to do. So I'm going to move on to, we can't put our faith and trust in the market. Neither can we put our faith and trust in the government. So, I'm going to share a couple of scripture verses that come to mind. And it says, "Do not lay up for yourself treasures on earth where moth and rust can destroy, and even where thieves can break in and steal. But lay up for yourself treasures in heaven where neither moth nor rust destroys, and even thieves cannot break in. But where your treasure is, that's going to be where your heart is." So James 5 says that gold and silver corrode, and their corrosion will be evidence against you that will eat your flesh like fire. So, again, we can't put our faith and trust in the government. We can't put our faith and trust in the stock market. We can't even put our faith and trust in the risings of gold and silver. And the only place that you can put your faith and trust in is the Lord Jesus Christ and Him alone. And so He is the only one that can protect us during a bear market and a market crash. And so with that being said, I hope that you have found this video to be at least insightful, resourceful. And if you have, I would appreciate it if you give it a like and subscribe to my channel. I hope you have a great day.